Hey everyone, this could be the most important video you will see today because in 3 key points you will be able to fully discover the Federal Reserve primary functions. I invested a lot of time reviewing academic researches so that you can easily figure out everything about the Federal Reserve. All you need is a few minutes to fully see the significance of one of the most important financial institutions in the world. Don't leave and watch this video to gain comprehensive understanding of the Federal Reserve. No one is talking about this, but I will tell you how the Fed creates and destroys money and how it affects your personal finance. The Fed decision is directly impact everything from your job security to your personal finance. Think about it. What if your bank suddenly closed and you lost all your savings? This is the kind of financial instability that led to the creation of the Federal Reserve. Hey, YouTube is an amazing source of knowledge. Please consider to subscribe to my channel. Thank you very much. So now we know why the Fed exists. Let's go back in time and understand how it is actually structured. The Fed wasn't born overnight. The Federal Reserve Act was established in 1913, marking a significant development in the American economic system. This system is not just one big bank in Washington. It is a decentralized system. That means it consists of a central board of governors and 12 regional reserve banks distributed across the country. These 12 regional banks allows the Fed to better understand the local economy. Each of these 12 banks serves its regions by supervising banks, providing financial services, and gathering economic data. This decentralized structure empowers each district. But at the top, we have the Federal Open Market Committee, which is in charge of monetary policy decisions. With that structure in mind, let's discuss the Fed primary functions. The Fed has several key functions. First, the Fed is responsible for conducting monetary policy. This is arguably their most important role, which includes influencing interest rates and credit conditions to promote maximum employment, stable prices, and moderate long-term interest rates. But the Fed responsibility is not limited. It also includes supervising and regulating banks. The Feds make sure banks are operating safely and soundly, protecting depositors and the financial system as a whole. Beyond regulating and supervising banks, it must also include maintaining the stability of the financial system. They are essentially the lenders of last resort, stepping in during crisis to provide liquidity and prevent financial panics. Okay, so the Fed has these important functions. How the Fed actually influences the economy. That's where monetary tools comes in. The Fed have several tools. First, let's look at the federal funds rates. This is the target rate that banks charge each other for overnight lending. The Fed influences this rate through open market operations. In addition to the funds rates, the Fed also has to work with the discount rate. This is the interest rate where banks can directly lend money from the Federal Reserve. A more direct influence in banks comes from adjusting reserves requirements. This is simply the percentage of deposits that banks are required to hold in reserves. Changing this requirement affects how much money banks can lend. However, by far the most frequently used tool and perhaps the most impactful tool is open market operations. This is buying and selling US market securities to influence the money supply and interest rates. To simplify, visualize the Fed as the person controlling the volume and equalizer. They consistently adjusting the levels to keep things balanced and preventing things from getting too quiet, recession, or too loud, inflation. Now we have explored these policy tools. Now let's talk about how the Fed can create and withdraw money from the economic machine. Understanding this next part is crucial because this next part might challenge what you think you know about money. The Fed is not just printing money and hand it out. Instead, they influence the money supply by open market operations. Imagine the US economy like big giant tank of water. The amount of water in the tank represents the money supply. The Fed can't just pour water into the tank. Instead, the Fed influences the level by controlling the flow of water in and out. When the Fed buys bonds, it's like adding water to the tank, increasing the money supply. On the other hand, when it sells bonds, it's like draining water out. It is all about managing the levels to keep the economy from overflowing inflations or running dry recessions. Now that we have covered all the complex topics, let's discuss the Federal Reserve independence. The Fed operates with a degree of independence, which aims to shield monetary policies from short-term political pressures. This is often debated. Supporters argue that independence allows the Fed to take tough decisions. Critics argue that the Fed is not sufficiently accountable for the public and that the Federal Reserve explained. I hope that this video helped you understand these powerful institutions.